In this video, I'd like to go back and review what we've done so far in Outdoor Outfit Company, put it together a little bit for you, and then move forward into explaining those flex budget variances in a bit more detail. So we have the same vignette we had before, and the first thing that we did was we looked at the static budget variances by comparing our actual results to the static budget, and then taking the difference between those two columns, and that gives us the static budget variance. And then we identified if each of those variances was favorable or unfavorable based on whether it would increase or decrease our gross margin or our operating income. I wanted to represent that a little bit more simply to give you a visual idea of what it is we're doing. And so I put that in one box on this spreadsheet, showing that the static budget variance is the difference between the actual results and the static budget. We'll come back to this sheet again in a minute. The next thing that we did was we took the actual results and the static budget and we moved them apart a little bit and put a third budget in the middle. That third budget in this case is called the flexible budget. And then by breaking that difference up into two pieces, actual results and flex budget, the difference between those two gives us our flex budget variances. Again, we identify whether that difference is likely to increase or decrease operating income all by itself. And then we compared the flex budget to the static budget, came up with a difference. That's our sales volume variance. And finally, at the end of that video, we added or netted the flex budget variance and the sales volume variance. And we discovered that if I add the flex budget variances to the sales volume variances, I get the static budget variance. So I added that to this spreadsheet by showing two new boxes. Our blue box is our flex budget variance, and it shows that that is the difference between the actual results and the flex budget. And on the right, we have a green box, the sales volume variance, and that's the difference between the flex budget and the static budget. And those two together equal the static budget, which is shown above it. What I want to do in this video is take that flex budget, primarily the flex budget, although we're also going to look a little bit at those volume variances, and we want to split that flex budget up into two additional pieces. We're going to do that by putting in yet another third budget in the middle. This one doesn't have a name. We're just going to call it the third budget. And it is going to allow us to take the difference between the actual results and the third budget. That will give us a price, cost, rate, or spending variance, something having to do with the dollar amount, depending on what it is we're looking at. And if we take the difference between the third budget and the flex budget, that gives us an efficiency or quantity variance having to do with the amount of inputs that we used. Those two variances together will equal the flex budget variance. So what we're doing is we're drilling down. We started out with our actual results versus our budget that we created before the year began, and we said, gosh, these are different. Why? And we split that into, well, part of it's different because we sold more than we expected or less than we expected. And part of it is different because our prices, costs, and inputs were different. But that's a lot of information all bunched into our flex budget variance. And so now we want to split it up and say, well, was it our dollars that was different, or was it our quantities that were different? And that's what we're going to do in this video. We're going to start with the selling price variance. So on this spreadsheet, I'm showing you a picture of the selling price variance. This variance is going to be slightly different from our next three variances, but we'll go ahead and we'll start with this one anyway. So in the left, on the green box, I have actual price times actual quantity. And if you think about that for a minute, that's what really happened, right? The actual quantity that we sold times the actual price that we received for those units is going to give us our actual revenue. Our actual revenue was $1,320,000. Now remember, we sold an actual quantity of 12,000 units, And in the last video, we divided the $1,320,000 of revenue by the 12,000 units and got an average selling price, an average actual selling price of $110 per unit. So this green box on the left is representing what really happened. All the way over here on the right, we have our standard price, which you'll recall was $105, and our expected quantity, which was 10,000 units. And if I multiply those together, I get $1,050,000. Now, in this example only, that ends up being the static budget. We're not going to use this as the static budget for our cost variances, for the next two cost variances, but for this one, this ends up being our static budget. And then that third budget in the middle is our actual quantity of 12,000 times our standard price of 105,000. This actually is our flex budget. If I take the difference between my actual and my flex budget, that's my flex budget variance of 60,000. It's also our price variance. Remember that we talked about on the flex budget, it's a favorable price variance in this case. So how much additional revenue we got because our average selling price was actually higher than what we had budgeted. And this is also the flex budget variance. Let's continue on with the difference between the flex budget and the static budget, and that is $210,000. And remember, we called that the sales volume variance. So now I've shown you a different way of getting the flex budget variance and the sales volume variance just for the selling price. And let's go ahead and see how that looks compared to what we did in the last video. You can see that the $60,000 selling price variance is shown in row 3 as our flex budget variance. So that is our flex budget variance. And the $210,000 is the same as our favorable sales volume variance. And if we compare it to our little map of how the variances work, you can see that the $60,000 price variance actually is also the flex budget variance. There is no efficiency variance on our selling price. And the sales volume variance, so those two together add up to the static budget variance, but they also match what we're talking about in this little map. In the next video, we're going to look at the direct cost variances, direct materials and direct labor, and see how we can split those into cost and efficiency or quantity variances. But for now, that's the end of this video.